Imagine you walk into a bank and ask for money. Not gold, not buried treasure, not a wagon pulled by nervous horses carrying silver coins under a tarp. Just numbers. And the bank says, approved. With a few keystrokes, your account balance rises. You feel richer. The car dealer smiles. The economy hums. And somewhere, hidden behind the curtain, a strange truth whispers. Much of the money in the modern economy begins its life as debt. Pause there, because that is not a side detail. That is the plot twist. The modern economy is not just a marketplace of goods and services. It is a giant web of promises, obligations, repayments, interest schedules, mortgages, bonds, credit cards, business loans, and government securities. In other words, we do not merely live in a money economy, we live in a debt-based economy. And tonight, we are going all the way down that rabbit hole. Not to panic, not to cosplay as a man yelling at pigeons outside the central bank, but to understand the machine. Because once you see it, you cannot unsee it. The Great Money Illusion. Most people imagine money like water in a tank. There's a fixed amount somewhere. Banks hold it. People borrow it. It sloshes around. The end. Nice story. Very comforting. Completely incomplete. In modern economies, most money is not physical cash. It is bank deposits, digital balances in accounts, and central bank and IMF explanations alike note that commercial bank lending plays a central role in creating those deposits. That means when banks make loans, they are not usually taking a sack of existing money from the vault labeled Steve's Savings and handing it to Janet for a new kitchen. In practice, bank lending creates a matching deposit in the borrower's account. Let that sink in. You ask for a loan. The bank creates an asset on its books, your promise to repay. At the same time, it creates a liability, the deposit now sitting in your account. Your debt becomes new purchasing power. That is the first secret of the debt-based economy. New money often enters the system because somebody, somewhere, went into debt. So when people say money doesn't grow on trees, they're right. It grows on balance sheets. Money is born screaming. Let's make this painfully simple. Suppose a bank gives you a $100,000 business loan. Before the loan, you do not have the money. After the loan, your bank account says $100,000. The bank's books say you owe $100,000. So the system just gained a deposit, money you can spend, and a debt, money you must repay. This is why the economy can expand with credit. More loans can mean more spending power, more investment, more hiring, more asset purchases, more activity. Central banks and the BIS describe this elasticity of bank liabilities and credit as a core feature of modern monetary systems. But now the story gets deliciously weird, because you do not just owe the principal, you owe principal plus interest. And that has launched 1,000 internet arguments. People say, wait, if banks create the principal but not the interest, then where does the interest come from? Is the whole thing mathematically impossible? Not exactly. The interest is not floating in a hidden cave under Switzerland, guarded by economists in capes. Interest payments are made from the wider circulation of money in the economy, from income, sales, wages, refinancing, asset sales, and other spending flows. Some borrowers repay because money created elsewhere also circulates through the system. The key constraint is not a simple missing money paradox, but whether incomes, credit conditions, and cash flows are strong enough for debts to be serviced. So the issue is not that repayment is logically impossible. The issue is that a system driven by debt tends to require continuous income generation, refinancing, rollover, or new lending to stay smooth. That is very different. That's the difference between a bicycle and a rocket. A bicycle can pause. A rocket really prefers not to. Why debt makes the economy go fast.
Now, to be fair, and we must be fair, debt is not evil. Debt is time travel. It lets the future fund the present. A family buys a house before saving cash for 30 years. A business builds a factory before waiting until 2049 to afford the bricks. A student pays for training before the first paycheck arrives. A government builds infrastructure before collecting taxes for a generation. Credit can accelerate production, innovation, and investment. That's one reason modern financial systems are built to expand credit elastically rather than operate on fixed quantities of physical cash. So debt is not just a burden, it's also an engine. But engines are wonderful until they're strapped to a shopping cart and pointed off a cliff. The catch: every boom has a shadow. Here's where the debt-based economy reveals its personality. When credit is easy, people borrow more. When people borrow more, spending rises. When spending rises, businesses expand. When optimism expands, asset prices often rise too. Homes go up, stocks go up, confidence goes up, and suddenly everybody thinks they're a genius. Your barber becomes a macro strategist. Your cousin starts saying things like, "Real estate never goes down, bro." A man with a podcast and a ring light explains leverage while standing in front of a rented Lamborghini. That's the bright side of credit. Then comes the other side. If debts rise faster than incomes, repayment gets harder. If interest rates rise, monthly payments climb for many borrowers. If banks tighten standards, refinancing gets harder. If asset prices fall, collateral weakens. And when enough balance sheets strain at the same time, a credit boom can reverse into a downturn. IMF and BIS materials both describe bank-created credit as something that can amplify financial cycles rather than merely passively reflect them. That's why debt-based systems can be dynamic and productive, and also fragile. They can sprint beautifully. They can also trip over their own shoelaces at highway speed. The central bank enters the story. Now enters the mysterious figure in every economic drama, the central bank. Cue the dramatic lighting. In the U.S., that's the Federal Reserve. In other countries, it's their national central bank. Its job is not to hand everybody free money and a stress ball. Central banks influence financial conditions in part by setting policy rates and conducting operations that affect liquidity and short-term funding conditions. The Bank of England and BIS both emphasize that in modern systems, the interest rate set by the central bank is a key anchor of the monetary system. So think of the central bank as the thermostat operator in a house full of people who keep lighting fires indoors. If the economy overheats, inflation rising, borrowing surging, speculation getting sweaty, it can raise rates to cool demand. If the economy freezes, spending collapsing, lending drying up, panic spreading, it can cut rates or inject liquidity to stabilize the system. This matters because in a debt-based economy, the price of money, the interest rate, is like gravity. When gravity is low, borrowing leaps. When gravity is high, borrowing lands face first. And because so much of money and activity are tied to credit, rate changes ripple through mortgages, business investment, government finance, consumer loans, and asset valuations. In plain English, when the central bank moves a quarter inch, the whole debt cathedral creaks. Governments live in the same story. Now let's widen the lens. Households borrow, businesses borrow, banks borrow, and yes, governments borrow too. Government debt is not the same thing as household debt. A sovereign government with its own currency operates under different institutional and monetary constraints than a family with a checking account. But governments still finance deficits through borrowing, often by issuing bonds into the financial system. This means public debt also becomes part of the architecture of the economy. Treasury securities aren't just money the government owes. They are also core financial assets, collateral, savings vehicles, and building blocks in the plumbing of finance. So when someone says debt is bad, the grown-up answer is, which debt, whose debt, at what rate, for what purpose, under what monetary regime, Held by whom? Used how? Because there's a difference between borrowing to build a power grid and borrowing to buy a gold-plated jet ski named fiscal responsibility. The real problem is not debt, it's misaligned debt. Here's where the conversation usually gets too shallow. People argue about whether debt is good or bad. That's like arguing whether fire is good or bad. It depends what's burning. Debt that funds productive capacity can increase future income. Debt that funds pure consumption may bring satisfaction now, but no added cash flow later. Debt that chases asset bubbles can make people feel rich without making the economy more productive. And when too much lending flows into speculation instead of production, the system can look wealthy while becoming more unstable underneath. BIS research
has repeatedly stressed the importance of how credit is allocated, not merely how much exists. That is the dark comedy of the debt-based economy. It can look healthiest precisely when it is getting sick. Everyone is buying, everyone is lending, everyone is expanding, everyone is celebrating. And buried under the confetti is one tiny question. Can the future actually pay for all this? If yes, prosperity. If no, documentary. Why it always feels like we must keep growing. Now we arrive at the philosophical basement. Why does modern life often feel like it cannot slow down? Why does the economy always seem to need more growth, more spending, more expansion, more output, more credit, more confidence? Because in a debt-based system, many promises about the future have already been made in the present. Mortgages assume future wages. Corporate loans assume future revenues. Government borrowing assumes future taxes and refinancing capacity. Asset prices often assume future cash flows discounted by current interest rates. The whole structure leans forward. It is built on expectations. And that means stagnation is not just boring, it is dangerous. A world with large debt loads becomes intensely sensitive to falling income, falling prices, tighter liquidity, or higher rates, because those changes make yesterday's promises harder to honor. That is why growth is not just celebrated in modern economies, it is often quietly required. Not because economists are paid in motivational posters, but because a heavily indebted system handles momentum better than standstill. So is this a scam? Now somebody in the comments is already typing, so basically it's all fake. No, that is too lazy. It is not fake because it is based on trust, contracts, institutions, and accounting entries. That is what modern finance is. Your paycheck is mostly digits. Your savings are mostly digits. Your mortgage is digits. Your taxes are digits. Your retirement account is digits wearing a suit. The system is real because the claims are enforceable, the institutions are organized, and people accept the money in payment. BIS work explicitly frames money, debt, and trust as intertwined foundations of the modern monetary order. But it is also true that this system is more psychological than many people realize. Confidence matters, liquidity matters, belief matters, coordination matters. A debt-based economy works beautifully when promises are credible. It gets ugly when everyone doubts at once. That is why banking crises are so terrifying. A bank can be alive on paper and dead by panic. The rabbit hole inside the rabbit hole. And now, for those of you who enjoy descending into economically haunted basements, the debt-based economy is not just about bank loans. It also includes corporate bonds, government bonds, money markets, mortgage-backed securities, consumer credit, interbank funding, shadow banking structures, and collateral chains so complicated they sound like a legal thriller written by caffeinated octopuses. All of these layers matter because debt instruments do more than record obligations. They also structure liquidity, collateral, settlement, maturity transformation, and the movement of risk through the financial system. So when people picture the economy, they often imagine shops, factories, trucks, farms, apps, restaurants. That is the visible economy.
Underneath it is the balance sheet economy, and the balance sheet economy often decides whether the visible one gets to breathe. The human cost. Now let's bring this down from the clouds, because this is not just theory. A debt-based economy touches daily life in painfully ordinary ways. Can you afford a home? Can your business survive higher rates? Can your wages outrun debt service? Can governments keep borrowing without crowding out other priorities? Can families absorb rent, food, transport, and interest payments all at once? When credit expands, opportunity expands for some people. When debt burdens become too heavy, freedom contracts. That is the emotional reality beneath the spreadsheets. Debt can buy time. Debt can also sell your future, one monthly payment at a time. And that is why financial literacy is not optional anymore. In a debt-based economy, ignorance is expensive, sometimes at 23% APR. The big reveal. So what is the debt-based economy really? It is a civilization organized around future promises. It pulls tomorrow into today. It turns confidence into purchasing power. It lets banks create deposits through lending. It lets states finance deficits through bond issuance. It lets central banks steer conditions by influencing the price and availability of credit. It is powerful, flexible, creative, dangerous, productive, fragile. It can build cities. It can inflate bubbles. It can fund invention. It can trap households. It can save a recession. It can magnify one. And once you understand that, you stop asking childish questions like, why don't they just print more money? And start asking adult questions like, what kind of credit is being created? Who benefits first? What backs the repayment? How exposed are incomes to higher rates? Is this growth productive or just leverage wearing makeup? That's the real conversation. The modern world does not run only on cash. It runs on confidence, on contracts, on leverage, on interest, on rollover, on balance sheets, on debt. That doesn't mean the system is doomed. It means the system has rules. And the people who understand those rules stop being shocked by the headlines. They see the machine moving before the noise begins. So the next time you hear about interest rates, bank lending, inflation, bond markets, deficits, housing bubbles, or credit crunches, remember, you are not watching separate stories. You're watching different chapters of the same book, the debt-based economy. If this video opened your eyes, type IOU in the comments. Subscribe because next we can go even deeper. Who really gets new money first, and why by the time it reaches you, the party may already be over.